In this section, you are going to learn about candle formations. Candle patterns or candle formations serve as visual clues to help identify the trend of the market, and it also assists in finding good entry and exit points. Trying to read charts without these visual clues can be like driving on a road with no road signs to warn about sharp turns, etc. In this session, I will discuss a few of the most powerful candle patterns available, and I will explain how to use them when looking for entry and exit points. There are many candle formations to choose from, but only a few are really worth knowing. Hammer candle formations, engulfing candles, and the dojis and spinning tops are some of the most valuable trend identifiers in technical analysis. Let's start with a bullish hammer candle formation. It's a highly reliable bullish reversal signal in a downward price movement. The long wick of the candle pointing to the downside with a small body at the high end of the candle signifies a weakening in bearish sentiment. The color of the hammer doesn't matter. It can be green or red. When you see this type of formation on your charts, it's a good indication that the market can change direction and we can start looking for a buy opportunity. Look at this example here. The wick of this hammer candle is longer than the body. It looks like a real hammer. It can have a bit of a wick to the upside like this, or it can be flat with no wick on the upside at all. The body of this hammer candle shows the strength or the sympathy of the market is bullish. The strength of a hammer candle depends on where it appears on the graph. An important rule for trading bullish reversal candle patterns is that it must occur at the end of a strong downtrend. One of the main characteristics of a hammer candle is that it should clearly stand out, with no candles on either side of the hammer candle to compete with. Look at this hammer candle here. This is a beautiful reversal signal. Trading a bullish hammer candle, the stop loss should go right at the low of the hammer candle. It is always good practice to wait for a confirmation candle. The confirmation candle is the candle immediately following the hammer candle. For a buy trade, the confirmation candle should be green. And the entry point will be here at the close of this confirmation candle. The bearish hammer candle is the opposite of the bullish hammer candle, and it is just as reliable and occurs at the end of an upward price movement. The long wick pointing to the upside with a small body at the low end of the candle signifies a weakening in a bullish trend. This is a good indication that the market can change from an uptrend to a downtrend, and we can start looking for a sell opportunity. The color of the hammer doesn't matter. It can be green or red, as long as the wick of the candle points to the upside and the body of the candle is to the downside. An important rule when trading a bearish hammer reversal candle is that it must occur at the end of a strong uptrend. One of the main characteristics of a bearish hammer candle is that it should clearly stand out, with no candles on either side of the hammer to compete with. A hammer candle, bearish or bullish in a sideways movement, also called a consolidation market, has little to no significance. Trading a bearish hammer candle formation, the stop loss should go right at the high point of your hammer. The more conservative trader will wait for a confirmation candle. The confirmation candle is the candle immediately following your hammer candle, and for a sell trade, the confirmation candle should be red. Your entry point will be at the close of the confirmation candle. Let's move on to the next important candle pattern, which is the engulfing candles. What qualifies as an engulfing candle is fairly simple. As long as the body of the candle engulfs the previous candle in terms of the body, it would be considered an engulfing candle. Where the hammer candle is a one-candle reversal pattern, the engulfing pattern is a two-candle reversal signal. The first candle of the pattern is a bearish candle in a downtrend. The size of the red candle is not that important, but it should not be a doji or a spinning top, which would be relatively easy to engulf. However, saying that, the signal is stronger when the first candle has a large real body. The second candle is a long green bullish candle that completely engulfs the first red candle's real body that managed to close above the red candle's opening price. The larger the green candle, the more bullish the formation. Both candles can have small wicks. However, the important thing you have to look for is the real body. This is a powerful reversal signal. The signal gets stronger if the second candle wraps around more than one of the previous candles. As this is a bullish reversal signal, we will only look for it in a downtrend. There are two ways to trade the bullish engulfing pattern. The more aggressive entry is to get into a buy trade on the close of the second candle of the formation. Your stop loss will go right at the lowest point of this formation, and the entry point will be at the close of the second candle of the pattern. The more conservative way to trade this formation is to wait for a confirmation candle. The confirmation candle is the candle immediately following the bullish engulfing pattern. For a bullish market, the confirmation candle should be green, and the entry point will be at the close of the confirmation candle. As with a bullish engulfing pattern, the bearish engulfing pattern is very easy to see and usually occurs at the top of an uptrend. The pattern consists of two candles. The first candle in the pattern is a green bullish candle, and the second candle is a long red bearish candle. The red bearish candle completely engulfs the body of the green candle. Not necessarily the shadow, just the body. This formation is even stronger when it engulfs the entire green bullish candle or when it engulfs more than one of the previous candles. Remember, bearish engulfing signals are only valid at the end of an uptrend. Just as with a bullish engulfing signal, with a bearish engulfing candle, the size of the first candle is not very important, but it should not be a doji or a spinning top, which is relatively easy to engulf. The second candle should be a long red candle. The bigger the candle, the more bearish. An important point to remember is to always wait for a candle to close before making a trading decision based on it. The safer way to trade the bearish engulfing pattern is to wait for a confirmation candle. The confirmation candle is the candle immediately following the bearish engulfing pattern. For a bearish market, the confirmation candle should be red, and your stop loss will go at the highest point of the engulfing formation. Let's move on to the next candle pattern, which are the spinning tops and the dojis. Spinning tops and dojis are some of the more important signals in candlestick analysis and signifies indecision between the bulls and the bears. These type of candles represent a lack of certainty in direction. Many traders treat the spinning top and the doji as a reversal pattern. The fact is, although a doji or a spinning top may signal a reversal in price, the only thing it lets us know for sure is that the market is unsure about the direction price should be going. A doji is formed when the open and the close of a candle are at the same place. The high point of the doji indicates that the bulls are in control, and the low point of the doji indicates that the bears are in control. But by the end of the time period, the market has closed unchanged. A doji is formed when the opening and the closing prices are equal. Spinning tops are similar to dojis, and in Forex they can be traded the same way. But with a spinning top, the opening and the closing price differs by only a few pips. A spinning top is a candlestick with a small body in the middle and long wicks on either side of the body. With a doji or a spinning top candle pattern, the market explores its options both upward and downward, but it lacks commitment. It's important to understand that dojis and spinning tops does not mean a reversal or a continuation in the trend, but it is really only a sign of indecision and can be seen as a period of resting after a significant up or down trend. Dojis and spinning tops can be used to prepare for possible entries, and you can use them to note areas of support and resistance. However, you should never make a decision based on a doji formation or a spinning top candlestick alone. Keep in mind that the market can do anything at any time. Just one last point before we close the session on candle formations. is that any of the above discussed candle formations has little to no significance in a consolidation market.